We're definitely not out of the woods yet, but with markets a little calmer, I thought it'd be good to discuss what we can learn from these past couple of months and the most recent stock market crash. We know there will be future crashes, and every crash will feel different, and they will all vary in how quickly they will recover. But no matter how many crashes we experience in our lifetime, they will still feel scary at the time. There will always be panic and hysteria in the media, causing anxiety across populations. That's why I think it's important to take some lessons from this most recent stock market crash to see how we can best prepare ourselves for the future. First, let's look at how this downturn compares to some of the other crashes in the past 25 years, starting with the dot-com bubble. So this was in the late 90s as the internet was booming and new technology. Tech stocks were very overvalued. There was a lot of excitement in the markets. And of course, at some point, that bubble was going to burst. Then in 2008, we saw the global credit crisis. Now, this was a larger crash because it was the actual system that broke. It was financial institutions that got greedy selling subprime mortgages, and that took a long time to recover. Then in 2020, we had the pandemic, which was a very sharp crash, but also a very quick recovery. It was sharp because of the severity of the lockdowns and just the speed that everything was moving. The recovery was very quick because governments and central banks, in response to the pandemic, started stimulating the economy. We wouldn't see the effects of this until 2022. Now with this most recent one, it's different again. It was caused politically. It was essentially caused by one man. Donald Trump introducing tariffs caused total pandemonium and chaos within the markets. It's important to analyze how and why these crashes happen because that gives us a clue on how they might recover. As easy it is for Trump to crash the markets, it's just as easy for him to stimulate the markets too. We saw this in the response to the market reaction. So after the tariffs announced, the stock market crashed. And I don't think Trump actually minds the stock market crashes per se. Like we even saw him gloating in the Oval Office with other guys who had made a fortune on the recovery. But what I really think got to him was the bond market. US bonds historically have been seen as a safe haven. People buy US debt because of the perceived safety of them. But what we saw in response to this was actually bond prices falling, which then caused yields to massively increase. Yields going up on government debt is a massive issue for the US government. They're sitting on a massive amount of debt that they need to refinance this month and later this year. And the higher those yields go, the more that's going to cost them. And I think what Trump wanted to avoid was the embarrassment of the Fed having to step in and buy back those bonds to bring those yields down. It's also seen as a bit of a weakness and embarrassment in that people were dumping US bonds in the first place. We can also draw comparisons from this to the UK. You may remember in 2022, the Liz Truss budget, where she announced some crazy tax cutting measures. This caused the pound to fall through the floor, the stock market, the bond prices as well, which then again caused yields to go up. The Bank of England actually had to step in to buy back those bonds to stabilize the market. And I think this was the exact thing that the US government wanted to avoid. But it also points to the fact that governments and central banks have so much power now to not necessarily avoid these crashes, but in the recovery of these crashes. They won't let the market fall more than 30%, for example, due to the embarrassment, but also just due to the amount of power and stimulation they can have on the economy. We saw what governments all around the world were willing to do in 2020 following the pandemic. Yes, there might be repercussions later down the line, but especially in democracies when governments are only in for 4 or 5 years, they're concerned with the right now. They want to avoid that embarrassment. The issues later down the line could be for a different government to deal with. We also have circuit breakers in the markets. Now, these were introduced back in 1987 following Black Monday, and they were amended in 2013 following the global credit crisis. Circuit breakers are designed to pause trading for the day. And on the New York Stock Exchange, they have 3 different tiers, from level 1 being 7%, level 2 being 13%, and level 3 being 20%. That's the amount that the stock market has to fall in that day for trading to be paused. Level 1 and level 2, the stock market is paused for 15 minutes. And then when it reaches level 3, it's paused for the rest of the day. They won't necessarily stop crashes altogether, but what it does do is just put a pause on things and allow traders to reevaluate their positions. But markets are always going to be hypersensitive and they're always going to react to news events. They'll also likely at some point revert back to the mean. So when we look at the stock market returns, on average, 9-10% over the past 70 years. But the actual annual rate is very rarely that average. You get wild swings, of course. In 2023, the S&P 500 did 26%. In 2024, it did 25%. That was predominantly brought about by a boom in AI stocks. Now, obviously, you can draw comparisons back to the dot-com bubble. So you could make the argument that if this tariff story didn't occur, we might have had another really positive year this year. But because the markets are trading so far above the mean, at some point they would correct because there would be essentially a bit of a bubble. And those stocks are a little bit overvalued. And the stock market was being dragged by the Magnificent Seven. And that's very different to the broad market all increasing at the same time. And that's why you can draw comparisons back to the dot-com bubble. The same thing happened in 2020. Over the past decade, from after the global credit crisis, there was a relative period of stability. Stocks were increasing at a nice rate, people were getting good returns. And even in 2018, 2019, people were starting to think that the stock market was a little bit overvalued, a little bit heated. And if 2020 didn't happen in terms of a pandemic, there might have been another factor or another situation that would have occurred that would have caused a bit of a correction. But the point I'm trying to make here is that, of course, crashes are inevitable and we're going to see them in the future, but we'll also never see them coming. They will always come as a surprise. Even those crashes where it's a correction because a bubble's burst or because stocks are overvalued. Yes, at some point people are saying these stocks are overvalued, but they might have said that too early, for example, and it's gone up another 20%. People were saying that in 2023, the market did 26%, and everyone was predicting 2024 to be a negative year and it was going to correct. And then the market goes and does 25%. So even if it then dips from there, it's still likely higher than it would have been if you tried to cash out at the end of 2023. Even with this most recent one and the tariff story, Trump made it very clear in the build up to the election, he was going to introduce tariffs. That didn't come as a surprise to everyone. What came as a surprise in how it came about and the severity of it and the lengths that he was willing to do to implement them. So the key here is to have faith in the recovery. Try not to panic when the market's going mental and the hysteria and the panic is getting out of control. There will be a recovery. We can look back of all of history. The stock market has a 100% recovery rate on recovering crashes. But the minute you try to time the market, not only timing the top, but also then trying to time to get back in, it's a losing game. You will lose money and you won't extract the full potential out of the stock market. Like I said, the stock market's averaged between 9 and 10% over the past 70 years. But most people don't extract that full percentage because they're trying to take money out of the market. They're then trying to time it to get back in. Who knows what's going to happen the rest of this year and even into next year, the repercussions on what that's going to look like. In the next 5 to 10 years, it's likely we'll have another correction, even another crash. Of course, we don't know what that's going to look like. The best way that you can be prepared is just having a long-term approach and being stable and try not to react too much. So if you're investing regularly into the stock market, that doesn't change. If anything, when the stock markets do correct, that's better for you. The key, I think, is when obviously people need to sell those investments, they need to take that money. And that's why it's important that you have your short-term savings set up. So you have your emergency fund. A general recommendation is 3 to 6 months of living expenses. Maybe also some short-term savings for a car, a holiday, maybe you're saving for a house. Things that you don't need to then sell your investments for, because the minute that you're using your investments to purchase something in the short term, that's when you start to make mistakes because you're potentially selling at a worse time. Of course, at some point, you need to sell the investments. There's no point just investing money and not reaping the rewards, but you can do that gradually. You don't always need to take a lump sum out. So if you are wanting to take some profits, you don't necessarily need to sell 100%. You can take a little bit off when you need to, potentially when later in life when you get closer to retirement. But if you've had that money invested for more than 5 years, it's likely you'll always have a positive return. And you can look back in history. Of course, there's never a guarantee of future results, but essentially that's all we've got to go on. And me personally, I will have faith in governments and central banks to help the recovery. They want to avoid the embarrassment of those crashes, especially if the crashes were actually caused by them. Let me know, what's your thoughts about this most recent crash? Are we out of the woods? Is there more to come? Let me know your thoughts in the comments below. Hope you found that useful. Check out my recommended investment apps in the description below. Like if you enjoyed it, subscribe if you're new, and I will catch you in the next one.